Okay, welcome to Investing with IBD, sponsored by Vantagepoint. I'm Justin Nielsen, and it's Wednesday, September 22nd, 2021. And joining me today is Irusha Peiris, O'Neill Global Advisors Portfolio Manager, my partner in crime, the Jerry Rice to my Joe Montana, joining me every week. And this week, we're doing something a little bit different. Irusha was getting a little jealous of all these guests that we were having on. He wanted some more time just spent on him. He's like, you used to treat me so well. And he wanted a little bit more of the me time. So Irusha, welcome back to the show.
Hey, Justin, it's great to be here. And we want to make this a monthly occurrence. This is our me time episode, or we time episode.
We time episode, exactly. So we'll of course be talking about the markets today. We had the Fed meeting happen today, and what is that doing for taper and talks of interest rate hikes. But really, it's more about this pullback that we had. Is this a bounce that we saw today that has some legs to it, or is this maybe the start of some trouble? So we'll get into that when we talk about the markets. And of course, football season has started. In addition to the podcast, Irusha and I also have some fantasy football stuff that we do together. We are co-managers of a team. So we're going to be using some analogies with football and investing to kind of share some of the outlooks that we see, and some of the lessons that we learn from football and how we apply them to our investing. And then, of course, we're going to end with some stock ideas. So Irusha, let's start it out. I think you were pretty vocal as the market was pulling back here, and we can just go ahead and pull up any of the indexes because they all pulled back. There was nothing spared, but we had a pretty decent drop on Monday, and I think a lot of people were starting to get concerned. Hey, is this the end? Are the good times over? But you were pointing out that you were trying to not panic. You were trying to make sure that you looked at opportunities that were appearing to potentially get into some stocks on the bounce. So how did you handle this latest pullback?
I'm not sure if I handled it well. I think I still
we'll
had
tell
a
you
little
in
bit.
A month, right?
Yeah, exactly. Yeah, it's funny. The market still forced my hand to lighten up, probably more than I wanted to, but I didn't get completely out of all my positions, right? I try to sell down to what they say the sleeping point. Right. And then today, after the Fed announcement and after the Fed news came out, slowly kind of built some of those positions back. I don't know if we're completely out of these volatile waters just yet, and we're through just yet, because the market did get hit quite a bit on Monday. But that being said, these markets continue to be very resilient. They continue, it seems like they take that one big hit, that one big shock, and then they start crawling up. I mean, it's almost like you have a one-day correction or that one little capitulation, and then that's it. All the bottom fishers are there. All the buy and the dippers are there, and we're back up to new highs within a few weeks. So that's been the character of the market, and you almost have to assume that that's going to be the character until proven otherwise.
Yeah, and I mean, look, we had the Fed meeting today. A lot of people are pointing to the fact that the taper, it's probably coming. I mean, Kenny Polcari, when we had him on the show a few weeks ago, was pretty vocal about how he'd like to see that normalization of rates. And it looks like November is kind of a reasonable expectation for the taper to begin. And look, we've got $120 billion a month that is going, getting pumped into the market. 80 billion into treasuries, 40 billion a month into government-backed mortgage securities. Taking that away, I mean, sure, that's I mean, just it being there, it makes you feel like, I mean, the money's got to go somewhere, right? And if we pull back to the S&P 500, I think the S&P 500 really shows how the pullbacks, the 50-day line, have been so orderly, it seems like, really since November. I mean, you could just count on, oh, you're going to pull back to the 50-day line, and then the buying is going to come right back in. And we haven't had more than a day really below the 50-day moving average line. This whole time. I mean, you had one day maybe where it closed below it in February, but the next day it was right back up. So the fact that we had, 3 days below it now, I guess could make some people a little bit concerned, but we're still not even more than 5% off of the highs. This one certainly felt a little bit more concerning. And I guess my other concern here is, how many times can you bounce off the 50-day moving average line? It's just, at a certain point, it's got to be overdone. Bill, when he was talking about individual stocks, he'd say, look, you can buy the first 1 or 2 times it bounces off the 50-day moving average line from a base. But beyond that, he'd get a little bit nervous. He'd want it to base again. And that's just something we haven't seen the indexes really do.
Yeah, but that was back when we had corrections.
No, that's true. Yeah,
apparently we don't have corrections anymore. But you do bring up a good point. This is the first time we've really broken the 50-day. And that will be something to watch. You want to see this. You want to see the indexes get back above their 50-day within the next week or so. You don't want them to start lingering around. If all of a sudden the 50-day, which has provided that floor, if it starts becoming a ceiling, and it starts living below the 50-day, that'll definitely be a little bit more cause for concern. And all of a sudden now you could start testing the lows of Monday too, and maybe start taking it out. And then you may start a little bit of a downtrend or a little bit more of an intermediate pullback.
Yeah, I mean, that change of character that you're talking about, living below the 50-day moving average line, that's like having one of your star players on your football team injured. At a certain point, it's going to be hard for the team to come back if it's limping along without someone. It depends on how deep your bench is. Just to start the football analogies, coming in here. But I will say that another thing that I felt like was notable about this market is that while you did have some of the growth names getting hit, you had a lot of growth names that were still acting very well. In fact, if we go ahead and go over to the FFTY, which is the IBD 50, this is the Innovator IBD 50 fund, an ETF that tracks the Investors Business Daily IBD 50 that we publish, every day. This, does a weekly rebalance, and you can see that's already bounced back to new highs. For the year, and it's, it really only came down to the 21-day moving average line. So a lot of growth was still hanging in there. Now, granted, this was, growth was having a tough time since mid-February, but it certainly seemed like growth was coming on stronger. The relative strength line was improving here. And then if we just go ahead and switch over to BOUT, BOUT, which is the IBD Breakout Stocks Index, also done by Innovator, you can see that that's fairly close to new highs as well, and had a very strong day today with a 2% gain. So what is your take on what's happening with a lot of the growth stocks?
I think underneath the surface, you have some, I don't know if you have necessarily broad participation just yet. A big key, especially when you're looking at the triple Qs or some of the larger cap tech indexes, they were being carried by the FANG stocks for a while. We started to lose a few of those FANG stocks. I mean, pulling up a Facebook right here.
That definitely stuck out today.
Yeah, so that was a little bit more of a cause for concern. And obviously, you don't want the indexes to start doing this, where Facebook broke the 50-day on Monday pretty convincingly. It had a little bit of a tiny weak kind of bounce on Tuesday, and then today it really started to tumble. And now you're starting to hear some news about the CFO leaving Facebook and all this kind of stuff. So, or the CTO, I think it was the CTO who's leaving Facebook, but. This is a reason for concern here, where I see like a Facebook or Apple already started breaking the 50-day before, and so maybe you have that rotation back out of some of these larger cap tech stocks, maybe back more into the smaller mid cap type of growth stocks. I mean, let's pull up the IWM here, which is the Russell 2000, made up of mainly small caps. They're not necessarily participating that much just yet. So it is interesting, I think, with the FFTY is at all-time highs here. So that does give me a little bit of hope, but you're not seeing that necessarily that broad participation that you ideally want to see. But overall, I think I am, I'm still bullish. I think we're still setting ourselves up for a nice year-end rally. It's just kind of surviving that chop before that, because there are a number of stocks over the last few days that they have hung in there. They are at new highs. They reacted pretty well once the whole Fed news got past the markets.
Well, we also, I guess, one of the things that was also concerning me is I feel like we've been climbing this wall of worry for a while. Between the Delta variant, and we've got the Fed. Fed coming out, taper talks, the fear of a taper tantrum, which didn't happen today, of course. But, it seemed like, on Monday, it was like, just give me a reason, where the market was coming down. And, a lot of people could point to all sorts of different reasons. One of them, of course, was, what's happening in China. Not only has the government kind of turned a little sour on some businesses, but now there was a big property company that wasn't going to be looking at getting a bailout, and the ripple effect that can happen when one of those big companies fails, and when a government allows it to fail, that sent ripples. So what is your take on some of the stuff that's happening in China and how that kind of trickles over to that's just a big economy, how that trickles over to our economy as well?
Yeah, we're just gonna have to wait and see. So now the kind of the news out on the Evergrande, obviously one of the largest developers out there, and they're in huge trouble with taking on way too much debt, and they're highly levered. We're just gonna have to see how big the cascade is, right? And how many companies are connected. Right now, it seems like it's not that bad. I mean, there is some connection, but it doesn't seem like everything's like tied into it, kind of like the financial crisis,
right?
12 years ago or whatever it was. But sometimes you don't always hear that whole story, right? No one's ever going to tell you the whole story.
It trickles out a little bit.
Yeah. Now, so on Monday, when that news kind of came out, I started reading a little bit more about it. Yeah, I got a little bit more nervous because they're so big, and it just seems like, there might be a lot of funds, that U.S. funds that might have invested in there. Now, if those U.S. funds start getting into trouble with some of those Chinese investments, they might have to liquidate some of their stocks, and that can all kind of fall. All of a sudden that selling could really beget more selling, and weakness begetting more weakness. But I don't know, with the way the markets have kind of turned it around, and they're acting, at least some the individual stocks, that smaller subset of stocks that are still acting okay. Maybe it's not as bad, or we're just gonna have to wait for the other shoe to drop. But right now, I think it's very clear. I mean, I pulled up the FXI right here, the China large cap. China's not a very good place to be investing in stocks right now. It hasn't been for a little while.
That was in a downtrend before, Monday. So
exactly. And that probably started happening once they announced in China about kind of leveling the playing field, and
there was the Alibaba stuff happening.
Exactly.
There's been a lot of this coming. So let's go ahead and tie a bow on this. If we bring up the NASDAQ again, what should people be looking at? I think one thing here is we can certainly use Monday's low as a level, look, or even the 50-day moving average line. If we start trading below that, as you said, if we are living below that, that's one thing. If we undercut Monday's low, then the market starts looking a little bit more like Facebook, where it had the drop, it had the inside day, and then it had the failure. So that would feel a little bit more like trouble brewing. But what is your take? What should people be looking for? Any particular levels?
I think you identify the lows right there with the low of Monday, and then that 14,423 level.
Yeah,
right.
August 19th low.
Yes, those are kind of the targets right there. And now the ultimate one would be that 14,200 level, because that's what, once it emerged out of that back in June, that's when a number of the tech stocks were able to get going. So those are kind of the levels. We are a market under pressure right now. We have 4 distribution days on the NASDAQ, and maybe 3 or 4 on the S&P. I can't remember exactly, but we're starting to collect some distribution days, right? So you're starting to get, from just looking at that point of view, you're starting to get a little bit of warning signs there. And so in the end, you want to, I think the big thing is you go through your portfolio, make sure the stocks that you're holding are still acting healthy, that they're still in uptrends, not that they don't look like a Facebook where they're breaking the 50-day and heavy volume. Even that, with a Facebook, I'll pull that up again. Even with a Facebook, yeah, this maybe today is a little bit. I mean, that's some pretty big volume coming into it. But on Monday, when it started to gap down below the 50, that wasn't necessarily you sell out of everything on Facebook if you already had a big profit in it. Right now, if you're down on it, then yeah, you want to protect yourself. But say you're up 30+%, you really earn the right to try to hold it a little bit longer if you wanted to. Now, today, with the volume increasing and making another low, I mean, you might want to lighten up more, maybe get out of it, right? So as long as your stocks aren't acting like a Facebook's acting and they're in uptrends and stuff like that, you don't necessarily have to do anything, but you do want to make sure you go and check everything because the environment might be changing. We might be going through a character change. And so you just want to be prepared just in case it is that scenario and it starts getting a little bit worse.
Yeah, so we'll go ahead and start talking a little bit more about some of the strategy things that we should be looking at, and we'll be using fantasy football as our kind of analogy for that. So make sure you stay tuned for that. We'll be right back. Do you want to conquer market volatility? We can help you protect your hard-earned capital. Visit www.freestockcoaching.com and find out how Vantagepoint's AI technology can forecast stock market trends up to 72 hours in advance with incredible accuracy. Vantagepoint's patented technology analyzes huge quantities of global data in seconds, so you can finally stop guessing what's going to happen next. Check out www.freestockcoaching.com and experience Vantagepoint for free. Learn how successful traders generate their wealth. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to Investing with IBD podcast, sponsored by Vantagepoint. It's Justin Nielsen along with my good friend Irusha Peiris. And let's see, we've got fantasy football to talk about. So, I mean, we've so far been 1-1 on our fantasy football team. And, it was a very devastating loss. That first week we had the second highest score of the league and still lost by, what was it? One or 2 points. Like it got really close at the end there. With stocks, a lot of what we're doing is we are picking, the best stocks that we see out there, the ones that are showing strength. But you're also, you're building a team when you're building your portfolio. You got to make sure that you don't have just one position strong. You've got to have kind of some diversity, some diversification amongst different sectors in your portfolio, just like you have different positions. So what is your take on some of the best analogies for football and stocks?
Yeah, well, really to start off, Justin, and for those of you who are listening, you can always go and watch the video version, so you can see both Justin and I have really come prepared for this football segment, wearing some football garb. Now, Justin's wearing his UCLA Bruins.
I should have put on the UCLA jersey.
You should have put the yes, and I'm wearing my Raiders Harvey Williams jersey that my friends got me because I was a huge Harvey Williams fan when they were the Los Angeles Raiders 20 plus years ago. And unfortunately, I can't say both of our teams won this past week. No. But
I will say, I mean, at least for UCLA, one of the things I was so impressed with the Fresno State quarterback, I gotta say, and just like the market, I mean, this guy was taking hits, and I mean, he was limping, at the end of the game, he was limping between plays, but then he was making these perfect passes. It was really amazing. And it just, the song from Chumbawamba kept on coming up. I get knocked down, but I get up again. I mean, and that's what this market feels like, right?
Yes. Yeah, that's true. That's a very, very good analogy right there. Now, and this is why Justin's so nice, because his team loses and he's praising the other team's quarterback. That's absolutely not what I would be doing.
That's
That
not how
is
you do
for
football.
sure. No, I don't. I'm very jealous of the UCLA Bruins when the USC Trojans are struggling left and right, and seeing you guys doing so well. But let's get to this analogy, because you started getting into it a little bit, and I've told my friends who are really into fantasy football, and Justin and I are kind of into fantasy football. But we do it. We dabble. So we do a team together, because at least we get to do it together and have fun and talk with each other. But I would tell my friends who are really serious into fantasy football that, hey, what you're doing in fantasy football, if you just took that excitement and that effort and put it into stocks, you do really well, because it's the same thing. And so in many ways, really, the first thing is, in fantasy football, the only time you can score points in fantasy football is when the season is on, right? Mm-hmm. You know, when the season is there, the football season started a couple of weeks ago. It's the only time your fantasy team can score points. In many ways, it's the same thing when you're in an uptrend with the markets, right, versus a correction, right? When you're in a correction, it's very hard to make money in stocks if you're trying to buy stocks to go up. Because if you're, especially, once upon a time we had correction, but when you had those corrections, it would be very hard. We learned years ago the hard way to stay on the sidelines. Don't push it. Let the markets come around, and then let the stock set up, because that's when you can get points. And then the same thing is, a lot of times we're taught, and through our methodology, look for some of the best industry groups. Right. Same thing with fantasy football. Look for the same best teams. Right. Figure out what are the best teams. Try to get their best players, because most likely they're going to be the ones to score most points. And if you have one of those members on the team, chances are your fantasy team is going to get some points, because that receiver is going to get a touchdown or whatever. And then finally, players and stocks are the same thing. You're analyzing, looking for the players with the most potential, that based on history, based on what they did last year, based on maybe they're a new rookie and they're coming in the right place. It's the same thing with stocks. We're using history, we're using metrics, we're using fundamental data to try to figure out, hey, is this a great company growing in a new market? And so we're going to take our chances on those stocks. And, and obviously we'll use charts too, to look for stocks that are uptrending, because we're betting that based on the history, based on the previous more recent behavior, that those stocks can continue to go up. So the way I look at it, there's so many similarities between both, because we just keep narrowing down the list of stocks to focus on in the same way that we're narrowing down the list of players to focus on in fantasy football.
Yeah. And to your point, look, if you've got 4 hours to watch a game on the weekend, how much time do you have to spend on, looking at your stocks and doing some research? One other thing, as you were talking about some of these rookies, this has certainly been a market of IPO stocks. A lot of stocks have come on the market this year, taking advantage of, the market being in such an incredible uptrend. And the way I look at it, a lot of times people are, we always want to see that history, right? We want to see some trading history. We want to see, hey, just like you want to see how the player does in the NFL, it's very different, right? It's very different from college going to the NFL. And it's very different. Like, you could have the, greatest things on sliced bread, but what does the market say? And you want some price history before you kind of, throw all your weight behind someone. But there's also, it's not like you're going in blind, because a lot of these IPOs do have some fundamental history. They do have a company behind that with earnings, and they have to give that information over to the SEC, before they, come public. So you do have some sense of what's going on there. So, but do you want a whole fantasy team full of rookie players?
Right.
I mean, I wouldn't, you have to just be very careful of, hey, look, it's great to take a flyer on some of these guys, and, and maybe have them on your bench. And if they start doing well, hey, they get up in their starters, just like you would maybe, hey, start a pilot position in one of your IPO stocks. And as the market tells you, hey, this is something that's really working, then you can put more money into it. So what is your take on the IPO market now? Do you think it's getting a little bit overdone? Are people getting too excited about the rookies?
Yeah, I always, it is getting a little overdone because there are a number of IPOs that have just gone on these insane runs.
Yeah.
But
and they're continuing.
They are continuing. Yeah. Unfortunately, I got out of some of those. But
yeah, right.
Yeah. So now some of those stocks are the odds are they're gonna turn out to be great companies, and so there it could be very validated. But so I don't know if I necessarily am seeing that crazy IPO speculation that I saw maybe like 4 or 5 months ago, where and then all those IPOs came in, or definitely like in 2016 when things were just going berserk at that point. So you're seeing some, but I'm not. I don't think I'm seeing it as much. So yeah, but I think that's a really good point with the rookies. You do not want to have too many of them in your portfolio, or your portfolio is going to go all over the place. Much like rookies are they're gonna freeze at the right time when they go from the college to the NFL because everything moves a lot faster.
Yeah, absolutely. So in terms of another analogy that I often think of, and again, this kind of gets back to my point when we were talking about the S&P 500 and how many times it's hit that 50-day moving average line and bounced. I always try to think of, and this actually comes straight from Bill O'Neill, what quarter of the game are we in? How much time do we have on the clock? Because you're going to play a little bit differently. When it's early on in the game, you're trying to establish your points versus, look, if you're way up and it's the end of the game, you're not going to be throwing Hail Marys. You're going to be running the ball. You're going to be protecting the ball. So given that we've had this big run from the coronavirus crash in 2020, so the move from the bottom of March 23rd, 2020 has been amazing. Some people even go back as far as 2009 and say, well, really, haven't we been in this long uptrend since we came out of the great financial crisis of 2008? So what quarter of the game do you think we're in? Or, are we already in overtime?
Yeah, well, the way I look at it is I'm looking at the bottom of in March 2020 was the beginning of a new bull market, right? So we're like a year and a half to.
So a new game in the season?
A new game in the season, exactly. Yeah, I don't look at the bull market as going from 2009. I think when people use that as the kind of the analogy, as 2009 as the beginning of the bull market all the way up till now, they're not necessarily investing in growth stocks because growth stocks have definitely gone through plenty of corrections during that time.
Right. And the indexes themselves, I mean, if we just look at the S&P 500 and look at a monthly chart, going back to 2009, you can see that even the indexes themselves have taken, maybe not corrections of, huge amounts, but they've definitely corrected through time.
Right.
I mean, if you were trading in 2015, you weren't making progress for a while there. If you were trading, 2011, we had the global recession fears. That was really choppy for a while.
Yes,
so we have had these pauses, which, again, getting back to what you were saying, it almost feels like a new game when you come out of that.
Yeah. So getting back to the original question of if we're, where are we in this? On average, and I don't know if this necessarily applies to us right now because of these are just such unusual circumstances with the Fed putting in so much money in March of 2020 to prevent things from getting much worse. Usually, on average, bull markets last 3.5 years, right? And then you get like a 9-month correction or something like that. I don't know if that necessarily happens. I think the correction starts, or I don't know if it's a correction or it's just a long pullback. But that's probably going to start whenever the Fed decides to taper. It's probably not rocket science at that point. So maybe it's middle of next year, maybe it's October of next year, whatever, depending on how the whole economy is doing. If it starts getting overheated, they're going to start raising rates a little bit and stuff like that. And like in 2018, the markets might really kind of
there was a little bit of a tantrum there.
Yeah, a little bit more than a tantrum though. They really killed the markets at that
point. Yeah.
So I think it is almost going to be, these markets don't seem like they're really going along with the economic cycle. It's more just with what the Fed's doing with the tapering or raising rates and all that stuff.
But to Powell's credit, though, I think,
Yeah.
he maybe made some missteps in his communication in 2018.
That's
and
true.
I do think that his communication has been, again, very, very clear. He's really tried to decouple the tapering from the interest rate hikes. And, of course, the big surprise, I guess, in today's announcement was that number of committee members that are thinking that rate hikes are going to happen in 2022 shifted from 7 to 9. So that means there's 9 people that think it's going to happen in 2022, 9 people that don't. And so that was kind of a hawkish shift. But he's also been very frank in terms of what the Fed is looking for. And I think everyone is on board with the fact that taper probably would have happened already if it hadn't been that you've got this oxymoron of, look, we've got this unemployment that is still pretty high, that you've got this tight labor market. And I mean, that's exactly what Powell was saying. So he's like, what do we do with that? And of course, you can lay all the blame on the Delta variant. It just kind of brought in some uncertainty where, you've got these, and this is exactly what Powell was saying. In the conference, the press conference, he's saying, look, there's some people that are probably like, yeah, I would go back to work, but man, this Delta variant, I don't want to go back to work and then 3 weeks later say, oh, I'm out again, type thing. So I think the Fed has taken a wait and see approach, like a lot of people have with the Delta variant. And it's been tricky. I mean, like, look at what happened with, with football itself. I mean, as COVID hit, I mean, it was, we've got a player out with COVID this,
that's right.
this week.
That's
we had to make some shifts, because the Delta variant has just kind of thrown a monkey wrench in some of these projections.
And going off with that, adjusting our teams and things like that, we had a player who unfortunately had an ACL injury, right? And he's out for the season. Mm-hmm. So we had to cut him. We had to get and pick up someone else. Same thing.
Cut your loss, would you say?
Yeah, exactly.
We're not going to keep him on the starting line.
We're not going to keep him on a roster. Sorry, But same thing with the stocks. If they start hitting your stop losses, you have to cut them from your portfolio. Let them prove themselves again, and then you can try it again. So next year, if that player that we cut is healthy again, we'll consider him for the team again, Mm-hmm. But you have to have a strategy. We wouldn't score any points. It's 100% guarantee. If we played that player this whole year with an ACL injury, he would score 0 points for us every single week.
We'll go ahead and take a break right now. And when we come back, we'll start talking about some stocks. Stay tuned. Do you feel like you're always late to the best trades? You don't have to kick yourself for those missed opportunities any longer. Today is your day. Vantagepoint's artificial intelligence has helped traders of all experience levels with its predictive analysis forecasting. Visit www.freestockcoaching.com and find out how their AI automatically recognizes global market patterns, well ahead of the news, to help you pick the best trade. Go to www.freestockcoaching.com to join a free live training session today. Vantagepoint's patented artificial intelligence can give you a massive edge. Don't hesitate, save your seat now. Trading involves financial risk and is not suitable for all investors. Past results do not guarantee future performance. Welcome back to the Investing with IBD podcast, sponsored by Vantagepoint. I'm Justin Nielsen, your host, and joining me this week, as he does every week, Irusha Peiris. And I should also mention, Irusha, I know you're transitioning from heading up MarketSmith, a job that you've done very well for a while, but with your portfolio manager duties, you're kind of coming out of that, but you're still going to be plugging a special offer that we have today, right?
Yeah, we had MarketSmith free access last week. Mm-hmm. And so this week we have extended access. So you have the opportunity to get 4 weeks for $24.95. So a month of MarketSmith for $24.95 versus the normal price, which is $149.95. So you can go to investors.com/MS4 weeks if you want to take advantage of that offer. The number 4.
Mm-hmm. Yeah, so very good. And again, this is what we use a lot to show our charts for those of you that are watching the video. But as we mentioned last week, there are a lot more features that we don't go over. And screening and all sorts of reports and things like that. So it's definitely worth checking out. And for 4 weeks at $24.95, it's not a bad idea to do that. So that extended access is something that is available now at investors.com/MS, the number 4 weeks. Okay, let's get into some stocks.
I'm impressed, Justin. I thought that you were going to mess that one up.
Oh, well, hey, you know what? A little bit of faith. Oh, ye of little faith. So, okay, let's talk stocks, and we can go ahead and start. I've got to say, it seemed to me that a lot of the home builders, the construction stocks, a lot of these stocks were setting up. One of those wall of worry things. I think a lot of people were looking at the infrastructure bill as, hey, this is a lot of money that's going to be pumped into the system. That was called into question as, some of the moderate Democrats and progressive Democrats were, jockeying around a little bit on the price tag. Some saying like, hey, 3 million is too much, and some saying, hey, we already compromised. We wanted I'm sorry, I should have said trillion. 3 trillion. You gotta add that T there, versus 6 trillion. So let's take a look at BLDR, which is Builders FirstSource. And this is one that we put on Swing Trader this week. Coming out of a cup with handle, you see, it already really came out of the cup with handle. And so what we really had was kind of an extra pullback. And it should be noted that this stock technically did not fail from that breakout. It did break out and it did pull back, but it got support just below the high of that previous handle, and it never came down more than 7%, 8% below your entry. So this is one of those cases where, look, if you had bought it at 55.17, you might have been sitting on a bigger loss. But if you had bought it right as it was coming out of that breakout, this might have been a little bit easier to weather the storm. What do you think of the price action here, Irusha?
I think it's acting well. It's kind of like a lot of stocks where they have tested you. They've really checked to see if you're a strong holder and you have conviction in the stock and you're willing to hold through a pullback. This is a good example of why, when you set your stops, when you have your exit strategy, the best thing a lot of times to do is stick with those exit strategies, because there are going to be times where they're not going to trigger your exit strategy, but you might be selling too soon, and I definitely do that. So it is something that you want to try to stick with, because it could be like Builders FirstSource, where on Monday it was probably looking really bad, but by the end of the day, you had that little bit of that upside reversal. And then today, I drew a little descending trend line there. It kind of emerged out of it. It's currently 2% from the original buy point out of that cup with handle. And what I like about this too is, before forming the cup with handle, it had a really nice strong prior uptrend. So acting really well, great earnings and sales. So this has a lot. There's a lot to like about this stock, and now we just have to wait and see if the market truly rewards it.
Yeah, and just as you said, I mean, it has to be realized that, okay, the Monday action, you look at it in hindsight and you see where it closed, and it looks easy, right? At one point, remember, that day looked very different. Rather than closing at the top of the range, you were looking at, oh, this is trading at the low of its range. And also remember that you're not trading in a vacuum, right? You've got all of these other stocks in your portfolio. And if you're looking at them, you're looking at the market coming down, and you're looking at this being at its lows, it's very easy to freak out. And this is why it can be very important to try and wait until the close of the day, or sometimes on these stocks that you've maybe been holding for a while, a lot of times we're looking at the close of the week, which is hard on a Monday when you're like, oh my gosh, if I'm going to try and wait until the close of the week, that's 4 days from now. How much destruction can happen in my portfolio in the meantime? So I guess, how do you handle that, Irusha? Are you pretty good at waiting until the close of the day, close of the week, or how do you make sure that you're not giving up too much when that initial kind of shot across the bow happens early in the week?
Yeah, I would definitely say I'm not very good at it, because it's that second part, what you were talking about, all your stocks come in. Right. And so when all your stocks come in, you're almost forced to do, you're almost forced to reduce a little bit, just in case things get worse and worse, right? So the way I have handled it in the past is when the markets are bad, like they're on Monday, you just want to try not to watch the markets too much. One thing that we've heard over the years from others who've been doing this for a lot longer is turn off your screens, right? Don't watch them, because the more you watch it, especially when it's a bad day, especially when you're emotional, the more reasons you're going to find to get out of the stock, right? And to break some of your, really just not to follow your plan, to break, to sell them too early, not let them hit the stops to really get out of it. So I think, yeah, you just don't want to watch it as much. You want to walk away from the screens, maybe not watch the market until the last hour of the day. Now, it was a little bit trickier this time because I won't even say at the last hour, things weren't looking great. It only really it only
last
seemed like the
half
stocks,
hour,
or maybe last
20
15 minutes. Then it was like, oh my God, it came back. And
then kind of the opposite happened on Tuesday, where it was kind of going back and forth, and then there was this kind of whoosh at the end where it really dropped a lot. Now, granted, that was still an inside day for the markets, and a lot of the stocks, it was still an inside day, so it wasn't too bad. But if you were looking at the intraday chart, and I think, to your point, sometimes you have to take that step back. If you're looking at the intraday chart, it was starting to look like, oh my gosh, things are crashing, But again, when you took that step back to the daily chart, oh, okay, these are still inside days for a lot of these stocks.
Yeah, and going off that time frame, if you want to, even on a Monday, if you want to try to hold on to some of these stocks a little bit longer, look at the weekly charts. Right. Don't even look at the daily charts, because the weekly chart will put even more perspective. But now with Builder FirstSource here on the weekly chart, we're recording this on Wednesday. You see on this weekly chart, if it were to finish the end of the week like this is a very positive week. You get this upside reversal, big shakeout, finding support off the 10-week line. Everything is very positive with this week, versus if you're watching it too closely, especially on that Monday, it looked terrible, and you're gonna sell out if you watch it too closely.
Let's go ahead and pull up AutoZone. AZO is the ticker symbol on this, because here we are. Again, in a kind of environment where used cars, because there's so few new cars getting produced because of the chip shortage, that's putting pressure on used cars. Pricing pressure there for some of the used car dealers like AutoNation that we've talked about, and also for people that are just trying to get their cars to last a little bit longer. But AutoZone, a strong move after earnings here.
Yeah, it reported earnings yesterday. You see and it had a nice little bit of an earnings gap right there, right near its all-time highs, and the high of the flat base, which was $1,666. It's just crazy, the prices of stocks these days.
Right.
But and then today it broke out, and the volume was okay. It's up 52%, which is pretty amazing for an AutoZone. And the relative strength line is near new highs. And this was actually one stock that I was looking at yesterday and today, just thinking about, maybe I should just buy a little bit of this and you just park some money and try to be like Bill, because I still remember that Bill story, which is now 10 years ago, which is pretty wild. But I just switched over to the weekly chart. You're getting the blue dot right there. So
definitely a different relative strength picture this time around.
That's true. That's true. But AutoZone has been working pretty well since March. It built that really long base, had a nice little uptrend, formed another.
But look at it in March. Look at how bad the relative strength line was. That's then true. Because it had, again, very similarly, it had gone through this very long basing period. And you know what? When you go through a very long basing period, like, look, David Ryan has talked about how he really likes some of these long bases. When you finally cross that line and start moving after a long base, he likes that. But that will sometimes have a negative effect on your relative strength rating and your relative strength line, because if other stocks have been moving during that time while you were taking a break, that's the way relative works, right?
Exactly. But now this stock seems to treat breakouts pretty well, though. Right. I mean, you're not going to get your 20% out of this. You might get like 8 to 10%. Then it may come back and find support off the 10-week line, build a new base. So you just have to know the character of the stock right here. But this is a stock that's trying to go again. And so, I mean, if you want a slower moving stock, it's one to consider. You have a couple of the IBD mutual funds in this stock too.
Yeah. Very good. Okay, let's go ahead and round this out with a look at FND, Floor and Decor. This is one, I mean, really, when you think about it, it hasn't been out for that long. Well, actually, it's getting there now. I mean, it's been a few years. I remember when this IPO just
2017.
2017. Because this is when we bought our house, and my wife was looking at flooring, and one of the things she liked about Floor and Decor was, gosh, those aisles had so much space in them. You could really kind of just put your tiles down, take a look at it,
cool.
and stuff. So when this IPO came out, I was really like kind of talking it up a little bit because my wife was super impressed with the way the store was laid out and everything. So this has had a decent move after a long time of not doing much. What Kathy Donnelly and Heath Bobach and Eric Kroll refer to as that due diligence phase.
Right.
But now here we are. A lot of the home builder related stocks have been doing pretty well, and this one just got supported its 10-week moving average line and looks like a fresh breakout.
Yeah, I mean, they have really good earnings and sales. You were talking about the acceleration of earnings before. This one's gone from, in December 20, 81% for the earnings to 100 to 462. Then the sales really has like 5 quarters from -11 to 31 to 37 to 41 to 86. Mm-hmm. So business keeps getting better and better for these guys, and you're seeing it reflected in the chart too. The relative strength lines at new highs. And what's interesting about this stock is it broke out of a coupled handle back in July, and that was a pretty good breakout too, 55%. Went on a really nice run, around 15% gain at that point, then came all the way back, almost right near the buy point of the coupled handle, but found support off the top of that handle and the 50-day, didn't break it, and it's now had a nice bounce. And the pattern recognition doesn't catch anything on the daily chart, but if you switch over to the weekly, there is another flat base there that you could use to buy out of, and it's currently 2% from that base right now. And so it broke out a couple of weeks ago, came back to the 10-week line this week, found support, and maybe on Monday it probably looked bad, right? It was probably scary. But right now, if the week closes like this is going to look like a pretty positive week here, and you're outside reversal, Justin.
Yeah, absolutely. You got that outside week, and right now we're closing at the top of that range. So we'll see how we close for the rest of the week. As we often say, it's not how you start, it's how you close. But getting to your point on that round trip or near round trip, Bill certainly has a rule where, look, if you've got a good gain, double-digit percentage gain, and you don't want to let the stock go negative on you. So in this case, it didn't, though. As you said, it kind of stopped at a logical area. Not only was it at the top of that prior base, it didn't go back into the base, which was positive, but it also got support right there at the 50-day moving average line. So if you had, again, waited until the close of that day, if we just shift back to the daily for those that are watching the video, you can see that, just waiting to the close of that day, at 110.71, where it came all the way back, you did stay above that level, so again, if you kind of had your line in the sand, not to go negative, or the 50-day moving average line, you did stay above both of those levels. Again, it would have been tough, especially because you had that earnings report, that came out, and you just kept on going down, a little bit afterwards. Well, that's going to do it for us for this week. I'm really glad that everyone kind of tuned in and bared with us as we talked about our football fantasy stuff and and shared some stories with you. Next week, we're going to have Mark Minervini. And I mean, Mark is just, we're welcoming him back to the show. Irusha had him on a few times as a guest, and we've had him on IBD Live. So just a wealth of knowledge there. You talk about someone who's been doing this, we've been at it for a couple decades. He was at it for a couple decades before we even started. So it's always nice to get, some real longevity there. He's seen it all. So make sure you tune in for that because he always has a wealth of knowledge to share. Thank you so much for joining us this week, and we'll see you right back here next week. Take care. And for this week's notes and charts, make sure to go to investors.com/podcast, where you'll find details for each episode in the podcast episode section. And make sure to subscribe, rate, and review our podcast if you haven't already. We'd really appreciate it. You can also send us your questions and comments to investingpodcast@investors.com. We would love to hear from you and may use your comments on an upcoming episode.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.